Hey guys, covered call ETFs promise high income, yields of 8 to 12% or more. But if you don't understand how they operate under the hood, you may be sacrificing growth. In this video, I'll walk you through how to evaluate what options are being sold in a covered call ETF and use an example of XYLD to calculate how much upside you may be giving up. Let's do this! If you've looked at funds like XYLD, the Global X S&P 500 Covered Call ETF, or funds like QYLD, JEPI in the US, or USCC, QQCC, HYLD in Canada, you'll notice big yields. But the problem is, many of these funds hold essentially the same underlying stocks or index. So what differentiates them? Today we'll cover the core mechanics of a covered call, how to compare funds with the same underlying positions, looking at three key components of the call option. We'll look at an example with XYLD and why less distribution often means higher total return, which is kind of counterintuitive. And at the end, I'll share why I personally don't own any covered call ETF and prefer the underlying stock or index. So let's start. Here's a quick refresher on how covered calls work. A covered call ETF holds a portfolio of stocks or an index. In the case of XYLD or USCC, it holds the S&P 500 index more or less. Then the fund sells, also known as rights, a call option on that portfolio. A call option gives the buyer the option to buy the shares at a specific price by a specific date for a specific cost. The money received from selling the call becomes part of the fund and may be distributed to shareholders. The price for the option is called the option premium. A call option can be sold in the money. That means the current price is more than the option price. At the money, meaning essentially the current price, or out of the money, meaning the strike price is above the current market price. A key point, this is a trade-off. By selling the call, you give up the right to upside above the strike price. The more aggressive the strike, i.e. nearer to the money, shorter the expiry, typically the higher the premium, the higher the yield. But the less upside you keep. So yield isn't free. You're trading potential growth for income. So how could you choose a covered call ETF? For simplicity's sake, we'll assume you know your asset allocation, your risk tolerance, what building blocks you want in your portfolio, if you want leverage, all that good stuff. But what if two covered call ETFs hold the exact same underlying, like the S&P 500 index or the same stock? The difference in performance often comes down to what options they are selling. There are three key variables: strike price, at the money, out of the money, in the money; the expiry, weekly, monthly, or even longer; and the coverage ratio, what percent of the holdings are covered by the options. A fund selling at the money monthly calls will extract more premium, more money, but cap upside more aggressively. A fund selling calls further out of the money may get less yield, but leave more upside potential. That potential upside translates into total return over time. Hence, when comparing two funds with the same underlying, we need to ask ourselves, what call options are being sold? Because everything else, the yield, the holdings, the provider, the distribution, the frequency of payments, all those things may be similar. But the option mechanics drive the difference in the return of a covered call fund. Let's pull a recent example using XYLD, a long-standing covered call ETF. As of late October 2025, XYLD is holding 4,643 call options on XPX. If you open the option chain, you'll see calls expiring on November 21st, 2025. XYLD sells monthly calls on SPX. In this case, you see XYLD sold the calls at a strike price of $66.20, expiring November 21st. Now let's do some rough calculations to see the moneyness of these call options. Spot or current price on October 17th, when the call was sold on SPX, was between 66.04 and 66.79, closing at 66.64. For this rough calculation, I'll take the midpoint at 66.42. The strike price was 66.20. That's only about 16 above spot or possibly 59 below. So very near to in the money or at the money. Now let's calculate the moneyness. I'll put on my screen the equation to find the moneyness, which is pretty simple. It's spot price minus strike price divided by spot. And in this case, it equates to 0.33% in the money. Now you want this number to be a negative to be out of the money. Now let's see approximated how much premium was collected for selling that. Say in this example, using 35 days to expiry, the same that they bought. It is about 133 on the open market. Just hypothetical, of course, which is approximately 2% of market price or spot price. So what does this mean? It means XYLD collects about 2% in premium over the time to expiry. But if the underlying index rises 3% in that period, XYLD would only keep up to that premium plus any dividends and miss the rest. In effect, the upside above spot plus the premium received is 66.42 plus the 132 is 67.54. At the time of writing this video, the price is 68.51 on November 3rd. That means if SPX stays flat from here, XYLD gave up 1.4% in just that one trade over 35 days from October 17 to November 21st. The fund would now likely roll this call, but that's another topic. If instead the fund sold a strike 4% out of the money, say at 6,900, then the premium would be lower, say about 0.33%, but you leave 4% of upside potential. Over time, that difference compounds like crazy. So when we see a fund with a very high yield, it's good to ask ourselves, at what strike price are they writing the calls? How far out of the money are they writing them? Also, what is the coverage? Meaning, how much of the portfolio is covered by the call options? Here's the counterintuitive takeaway. The covered call ETFs with the highest yields are often the ones that give up the most upside and thus deliver the lowest total returns over time. Does that make sense? If Fund A yields 10% because it sells at the money monthly calls, giving up the most upside, and Fund B yields 6%, let's say, because it sells deep out of the money monthly calls, giving up much less upside, over time, Fund B will outperform Fund A because it preserves the growth. The market as a whole, including an index like the S&P 500 index, is expected to grow. We all know that. The lesson? Yield's a starting point, not the end point. We need to evaluate the option strategy, the strike, the expiry, the coverage, and estimate how much upside is being sacrificed. Yes, it's a sacrifice to get that income right now. It isn't free money, and it definitely isn't the total return. Let me show you an example of a fund that sells out of the money calls on the S&P 500 and its components with a maximum coverage of about 33%. ESPX by Evolve. You can see here it sold a call on IVV at 688, expiring November 21st. IVV was trading at 662 to 669 on the day, implying a 3% out of the money call on the index. Let's now compare XYLD to ESPX for total returns. XYLD has a yield of about 13%. It sells at or in the money monthly calls with 100% coverage of the portfolio. ESPX, on the other hand, has a yield of 9.6%. It sells out of the money calls monthly on the index and its holdings with a maximum coverage of only 1/3 or 33%. Since inception, ESPXB, that's the unhedged version, has returned 51% since December 29, 2023. XYLD has returned 17.1%. Big difference. USCC, which is similar to XYLD in Canada, but has only 50% coverage, so that's half, it returned 45% over the last 2 years. Now, VFV, a Canadian unhedged S&P 500 index, has returned 55%. Did you notice the trend? The less the coverage, the more out of the money the calls, the higher the total return. So if I was forced to pick between those three covered call ETFs, I'd go for ESPX because it sells out of the money calls with the least amount of coverage. Now, if you found this useful, hit that like button, subscribe for more content, and please comment below on which covered call ETFs you've been looking at and at what strike price / moneyness are they using. Here's why I personally wouldn't own a covered call ETF, and instead I'd prefer to hold the underlying index or stock itself. My reasons are backed by a study, a devil's bargain. Tax efficiency. The large monthly distributions from covered call ETFs are taxed as capital gains in Canada and in other countries, slowing down compounding compared to just holding the underlying. Capped upside. By selling calls, I'd be giving up potential upside, and over a very long investment horizon, compounding of growth matters immensely, even in someone's retirement. Also, I could replicate it myself. If I truly want income, I would own the underlying and write my own calls with the strike, expiry, and coverage that I choose, though that does take more effort and option knowledge. Overall underperformance. Data suggests that many covered call ETFs lag their underlying index in total return, precisely because of the upside sacrifice. So those high fees, the capped upside, and the tax drag all lead to underperformance. So if I were advising someone whose primary goal is long-term wealth accumulation rather than short-term high income, i.e., let's say less than a year, I'd argue skip the covered call ETF and just hold the broad index or the stock. Let it grow and generate dividend income in other ways as needed, even by selling some of your portfolio. That said, if someone's explicit objective is income and they're comfortable with giving up growth, having higher risk, and paying more in fees, then a covered call ETF may have a role. But it's important they understand the sacrifice, the trade-off. Thank you so much for watching, guys. Until next time, I'm Mr. Financial.